Welcome to your weekly market update where we talk about everything mortgage and real estate related. I hope you all had a wonderful holiday break and a happy new year. We have some great information to talk about as always, so let's jump right in it. First off, pending home sales, which measured signed contracts on existing home, were flat in November. The market was expecting a 1% gain, so this was a small miss. The previous report, however, was revised slightly higher. While the drop in rates in November did not cause more signed contracts, the lockbox indicators showed that there was more interest and activity. Additionally, rates continue to drop in December, which should lead to a much stronger December report. Sales are now down 5.2% year over year. The future looks good for home appreciation. Fannie Mae and Pulse Economics released the results for their Q4 home price expectation survey, showing that over 100 of the top housing experts in the country believe home prices will rise on average by 2.4% next year and 25% over the next 5 years. This is the average, which means that there are many that are pessimistic, while many are much more optimistic. Oftentimes, this causes a survey to undershoot appreciation. For example, last survey done 1 quarter ago showed full year appreciation at 3.3, which was revised to 5.9% in this latest report. The most pessimistic believe homes will appreciate by 10% over the next 5 years, while the most optimists believe they will raise by up to 40%. Almost 50% believe we will get to a recession by the first half of the year, which would cause mortgages to decline and likely cause appreciation even higher. Per MBS Highway, this is the same survey that we won 3 Crystal Ball Awards from, and our estimates of 2023 of 6.8% appear to be right on track. We also think that we will see a 4.5% to 5% appreciation next year. Now, as for mortgages and inflation, the Fed's favorite measure of inflation, personal consumption expenditures, show that inflation came down more than expected in November. Headline or all-in inflation fell 0.1% from the month versus the flat reading expected. This caused the year-over-year reading to decline by 3% to 2.6, which was much lower than the 2.8 expected. Leading economic indicators, which is a forward-looking indicator of the health of the economy, was down 0.5% in November, which is the 20th consecutive negative reading. Historically, once this report turns negative, this, on average, a 22-month lead time until we enter a recession. This report not only turned negative 20 months ago, but the reading has been negative for 20 months in a row. Mortgage rates have stayed flat the last 2 weeks, remaining around 6.6%, roughly a 0.25% higher than this time last year. Tomorrow and Friday, we'll have the jobs report for December. If that comes in worse than expected, we could see rates drop even more. Let's get prepared for a busy start to the year.